And so for this week, I want to go to the other methods. I want to start talking about the other methods. The other methods are the comparable company analysis and the precedent transaction analysis. So remember what the benefits and drawbacks are of each. Do you remember what the benefits and drawbacks are of each of the comps and the PPAs? What is it? What is the meaning and the need for the comps? Anybody? Comps? What is the comps? How do you explain the comps? Comparable company analysis. We're going to go through that today. What do you guys think? Comps are, just pulling it up. Anybody? Gonna wake you guys up. What do you think? Ray? What are the comps?
So, in terms of a comparable company,
yeah.
Use the current data.
Good.
Use the.
You're right.
Yeah.
For what purpose?
So if you find some competitors in the same industry, similar size, and then you can
yeah. And what's the benefit of the comps?
Use the latest data.
Total current, based on the stock price. It is as current a measure of what your company could be worth, if you believe in that, right? We're going back to the original example where we said, well, how do you value like a car? And there's two ways to value a car. You can value it based on the book. You can look up like the blue book and see what your old used car is worth. Or you could say, you know what, if I put it on Craigslist and someone who pays more for it, to me that's the value. That value is what someone's going to actually pay for it. So the comps is the measure of what somebody would actually pay for it. Or at all, you had a question?
Isn't it kind of verification the value of your company?
Yeah, it's a good verification. If somebody is willing to pay for that stock, that's the implied value of the company. What's a drawback of comps? It's like a drawback.
Well, it's not easy to find always the match.
Yeah. Yeah, it's not easy to find like companies in terms of product, in terms of geographic scope, in terms of size. And Walmart's a great example. Right? We're going to do a comp for Walmart. And if you look up who Walmart's quote-unquote comps are, then number 2 is like Costco or something. And Costco is like $60 billion, and Walmart is like $250 billion. It's just, does Walmart really have any true competitors that are of that size? No, that's a difficult thing. That's something that we're going to consider. When we look at comps analysis, you're always going to have in the back of your mind, yeah, but these companies are so much smaller. Are they really comparable? Well, that's a problem. Okay. Next, precedent transactions. Precedent transactions is similar in comps as it's a table of multiples. It's a table of metrics. The benefit of the precedent transactions analysis is it gives you a purchase price. It gives you the value of what somebody paid for a specific company, which for us, if we're doing this for an M&A analysis, it can give us an implied premium. That's the benefit. Drawback to that is precedent transactions are really difficult to get. We'll see a lot of times, difficult in terms of what precedent transactions actually is if we want to value our company, the value to us is the value that somebody would pay for, not the stock price, but the whole entire company. So we go back and we look at past acquisitions of companies that are similar to ours. So number one, that might not have happened. I mean, has anybody acquired a $250 billion retailer? I don't know. I don't think so. So what's similar to that? And then two, if you do find some sort of M&A activity that's similar to that, it's sometimes almost difficult to get the underlying data, especially if the acquisition is a private one. So you see it. So we'll look at it. It's a table of multiples, but a lot of NAs, a lot of not availables. That's common to see that in the pitch book. So we'll look at that. But the benefit to the precedent transaction analysis is it gives you a premium. So if you're actually looking to buy a company for like a pitch book, an M&A pitch, and you want to see, well, how much of a premium would somebody pay above and beyond, because when you're doing an M&A analysis, you have to pay this control premium, which is indicative of a percentage above the current market value to convince the shareholders to give you their shares. Sometimes it's difficult. Well, how much of a premium do I need to spend to convince all the shareholders to give me their shares? We're going to talk about that. The precedent transactions can give you an idea as to how much of a premium you need to spend. That's the benefit of that. So we're going to look at both. Today we're going to look at comparable companies analysis. So the first question I want to answer is, how do we find comparable companies for Walmart? How do you go through that process? There's a couple of resources I recommend, just as a quick overview. One is, first of all, to go to, I'm not going to do it here, but to go to the annual report or the 10K and just do a word search on competitors or competitive environment. Actually, we'll just check the box here. Oh, excuse me. I had deleted the Walmart annual report thinking we were done with it. Pull it up again. Here it is. Okay. I didn't, not that I deleted it, I just moved it away. Okay. So, okay, I thought I moved it, and then I guess the move didn't happen. So let me just pull it up again. Walmart annual report. Okay. There. Okay. Oops. So if you do a word search, I don't remember if it comes up for Walmart or not, but competitors or competition, they usually discuss, here we go. We operate in a highly competitive retail industry. We face strong sales. Okay. So in this case, there's usually a paragraph about competition. Sometimes they name the competitors, sometimes they don't. If they do name the competitors, that's great. It's a great resource. Here, I don't think they did. Yeah, they didn't. Now, let me just see if there might be another note on competition or competitors. No, that's the only one. Okay. And let me just see. Okay, I didn't think that they did. But this is just to show you, this is one thing that you'd want to do. Okay, and even if they have their listed competitors, you might want to second guess that. So always go on the website, the investor relations section, go to investor's presentation. They might talk about the industry. They usually have a page on the industry. You can see what other companies they mention. A great tool is in Yahoo Finance. They have the industry tool. I think we kind of looked at that before. Okay, so if I do, like, let me pull up Walmart. There's this industry searcher that you can download into Excel that lists all the companies in the industry, and I would use those. I would just use those. And you would pull anywhere from 6 to 8, maybe even 12 companies, and you'd have to do a comparable company analysis on each one. As I mentioned on Thursday, the comps analysis, it's a procedure that I want to make sure that you know how to do the right way. Well, a lot of times you get pulled in a deal. Even when I was at Morgan Stanley, they said, you know what, just get them from Capital IQ. Just pull the metrics from Capital IQ, or just pull, which is fine if you're kind of rushed, but in reality, you want to do comps the right way. And although I did mention that at Morgan Stanley, that's the way it's done when you're sometimes when you're pulled, real quick. But in actuality, in the very beginning, we had 268 analysts when I was a first-year analyst. Your job, everyone, the only thing that you did for the first month or so was you were assigned to comps. Everybody had like 6 companies, and you had to spend the first month putting together comps. And your diligence in that, how well you effectively put together comps, your accuracy, and the detail that you were able to do that helped determine whether you'd be staffed in the first deal or not. So everyone was sitting around all nervous about getting staffed. And I saw analysts never get staffed, and never got staffed in 2 years because they just kept screwing up their comps. And people would tell. So, it's not something that I've ever seen been tested in a case study. Case studies are usually modeling based, but I have heard people say, oh, have you done comps? Want to make sure that you've done comps, you've done a pitch book, and you've obviously the modeling too. Have you done comps? And if you say yes, and they say, well, how did you do it? I don't want you to say I downloaded it from Capital IQ. I want you to say I pulled the Ks, I pulled the Qs, and I pulled out non-recurring, the process that I'm going to show you. So my point is, you probably won't sit down and be tested on it, and I'm not going to test you on it, but you should know how it's done so you can talk about how it's done. So we're going to do one, okay? So here's did Walmart pull up? Here's Walmart. The stock price dropped quite a bit. And there should be an industry. Now, they changed the whole format here. They used to have a left bar where they had industry, okay? So I need to kind of get familiar with, there's a company profile. There should be an industry, okay, there should be an industry searcher here. The other way I can go about it is go to industries, but I hate to lose where we're at because it should generally pull up the industry that Walmart specifically is in. So let me just pull up statistics real quick. I got to get familiar with this new layout. I'm sorry. Valuation measures. Okay, I'm familiar with the underlying data. They just changed the way it's laid out, how to pull it. Maybe profile. They used to have a toolbar on the left that I was more used to how it was organized. They literally just changed it, I think, over the summer. Okay, this is some overview information. Here's the financials. Okay, it's too bad. I don't know if they did something else weird here. Hold on. It's not going to be holders. It's not going to be historical. I don't think it's going to talk about it in analysts. I just want to make sure this is active here. Then we'll have to go to industries and try to pull this out here. This data isn't changing is the problem. So now we have a okay, so unfortunately they keep tweaking the layout here. So what I had to do was I went to industries up top, and then I went to retail, which Walmart is in, and they listed, they pulled up a list, and it's downloadable into Excel. I guess something clicked and it moved. And you can sort it by market cap. So that's what I had done. Okay. Now it's okay, here it is. So there's Walmart right there. You can sort it by market cap. There it is. And there's Walmart, there's Amazon, there's Home Depot. And then what I would do is just pull out the ones that are really kind of similar in nature to Starbucks, to Walmart subsector, and I'd use those companies. So it's, you can download this into Excel. There's a lot of data that you can use if you're looking for target companies. It's a pretty powerful kind of tool, and it looks like they tried to make it. It looks like it's actually live, which is something new, which is pretty cool. So a little bit painful. It took me a while to get there because this is slow, but at the same time, I guess they added more functionality to it. So when I pulled its competitors, based on that, this is what we came up with. And I'm going to pull up the Excel. Everybody should have this model. I can put it on a flash stick if you don't, because we're going to work with this now. Willie, do you have a flash stick? Do you want me to give it to you on a flash stick? And yeah, you might have it. Okay, right, because you did that. Here's the comparable companies. So we had come up with Costco, Target, Dollar General, Dollar Tree, and Family Dollar Store. Now, this is my point. When you look up the subsector that Walmart's in, so the big box retailers, Costco was next in the list, and then Target. And these guys are like $60 to $40 billion market cap respectively, versus Walmart's $250 billion. So the question is, are they truly competitive to Walmart? And that's the problem. So, you might not have to face this issue, and you usually don't. Just Walmart is just so exceptional in its own right. Should we be comparing Walmart with other companies of that size? But then you're looking at Apple and Home Depot, and those companies really aren't similar in product base to Walmart. So does Walmart really have competitors? That's an issue that needs to be debated. But for the process of illustrating for you how this works, let's just assume we're going to run these comps with Costco, Target, Dollar General, Dollar Tree. So this is what it looks like. It's a table of multiples. We've done everything except for Costco, and I want us to do Costco together. Okay? I want to show you, just in terms of the results, what we had done was we had pulled the following various multiples: PE, enterprise value to sales, enterprise value to EBIT, enterprise value to EBITDA. Those are the most common. Every firm has their own template with it, but there's usually a template. But if you don't know and somebody says just pull in all the multiple, these are the major ones, right? Price to earnings, enterprise value to sales, enterprise value to EBIT, enterprise value to EBITDA. Another question most commonly received is, what about the timing? Some people want to see 2 years out. Some people want to see 3 years historical. Some people want to see, it all depends on the group that you're in and the culture of the group and the template. So what I've done here, just to keep everything standard convention, is I did one historical set of multiples. So I did last year's, 2012 actual. Last year's, as per the model in the book, 2012 actual. I did one current, LTM, when we talk about LTM, is the last 12 months. It's the most current to today. Today, quote unquote, from when the book was written. LTM. And then I did one projected year. The reason why I did one of each is because I want us to go through and understand how to do multiples in different times. How do you do one historical year, one super current LTM, and then one projected out? And if somebody tells you to do 2 projected years or 2 years historical, you know how to do that, right? So I did each of the major metrics, and then one historical, one current, one forward projected. So I want us to look at Costco and to pull in historicals, LTM, and projected. Okay, so the first thing I had done was I went to sec.gov and I pulled up all of Costco's current reports, and I did that. And I'll email this to you. I'll put this up on the OneDrive. These are all their reports. So I just pulled that. Went to sec.gov. I pulled in their latest 10K. Their latest 10K was of October 19th, 2012. This is about when I finished writing the book. I think it was the end of October. I wrote the first draft. So all the numbers are as of that. So they actually had just produced a report at that time. So I want to open that up. And then everything else. We're going to use the other report soon, but I just pulled the latest K. And I said, and I pulled up, I made a tab for the Costco comp. This is the tab. Okay. If everyone pulls this tab. And it didn't have all these columns yet, but we're going to see later on. I want to do quarterlies later. But for now, what I had done and what I would have done if I were in your shoes having to do comp is get the latest 10K and pull in the latest 10K information to become familiar with how they do things. I want to lay out the income statement. So what I'm going to do is, I don't know if you guys know about grouping and ungrouping, but if I hit if I hit 3, I have to enable editing. I don't know why it asks me that. Okay. And then I'm going to hit 1, and it's going to close everything, leaving me with just the 2012 numbers and then projected estimates. Let's just start analyzing this on an annual basis. The first thing I do is I pull up the annual report and I'd lay out income statement information, which is pretty standard for most of you guys. For other people, it's good practice laying out an income statement. The trick here is with comps, you want everything to be cleaned. No non-recurring events. Non-recurring events pulled out. So lessons here, although you probably know about income statement, is practicing how to reorganize a series of line items into an analysis for us so that we have EBITDA, we have EBIT, we have non-recurring events pulled out. How do we properly pull out non-recurring events from above the line to underneath the line? How do we deal with taxes? These are things that I want to make sure that you know, and how to do that when making projections. Okay? So let's see what they got. So when I pulled up the annual report, I just want to jump to the income statement. So I'm going to scroll down real quick, look for their income statement. You just go look for the big table of numbers. That's the way I do it. That's a small table of numbers. We're getting to bigger tables of numbers. Now we're getting to blank pages. I think that's just because the screen isn't refreshing properly. Okay, we're starting to get into the financials here. It looks like they moved the financials to an appendix. Here's a balance sheet, getting closer. Statement of income, very simple. Okay, here's a statement of income. Now, the revenue they are producing. We could do 2012 and 2011 simultaneously. We might as well. The revenue that they're producing is based in 2 components, sales and membership fees. Okay, now, if you remember, Walmart did the same thing. They had sales, they had membership fees from Sam's Club. So good, fine. Great, we're going to lay this out. How about costs? Merchandise costs, SG&A, pre-opening expenses. What do we deal with those costs? How do we deal with those costs? Do we just list them as is, or what do we do? What do we do with those? Not all of them. What's cost of goods sold here? They got to have some cost of goods sold. Merchandise costs. COGS. It's the cost of the merchandise. Cost of the, right? That's COGS. So we got to move that into COGS. SG&A, OPEX, pre-opening expenses. Why the shoulder shrug? No, because that's the kind of way I thought about it. Like, huh. So would you say? It could be SG&A. What are pre-opening costs?
Probably have to read it up there.
Yeah, and I don't want to go through, and I did read it, and if they have a scale plan to open 10 stores a year, there's seeking out the building, analyzing the building, dealing with lawyers, dealing with the town, zoning issues, all this stuff, all this before you open, buying an initial inventory. So the question is, for pre-opening costs, is this going to happen all the time? Is it recurring? It's kind of. What do you mean kind of?
Well, they may do for 10 years and then next year they may not do that.
Right. Now, with the comp's eye, there's two things you have to think about. Number one, is it recurring for this company? And number two, is every other company you're comparing against going to have this line item? Remember, you want everything comparable. So in other words, if Walmart doesn't do this, you might not want to include it because this is exceptional. So you have to think about that. This is where it's careful. So I went back to, I like the example of, we went back in the very first week, we talked about the car company and talking about other income. You have a car company and its business is selling cars. Then all of a sudden this car company decides to say, you know what, I'm going to finance. I want to have a financing business where I sell you the car and then you pay me in increments and I generate basically income from those financing fees. And I say, well, because of the bylaws, I can't yet consider that revenue. Now, do you that income that you're receiving, do you put that above EBITDA or below EBITDA? It depends, right? If you're buying the company and you want to value that you buy the company, we talked about, well, you buy the company and you want to value that business. And if you're going to buy the company, you're going to take not only the selling of the car business, but you're also going to take that financing arm as well. Then you want to count that. You want to consider that. So you want that line item above EBITDA, meaning I want that income stream as part of my EBITDA to value the business, kind of value the business off EBITDA. On the other hand, if you're a big car company trying to buy this car company and you already have your own financing business, you say, well, I don't care about that. I'm going to buy the company. I'm going to shut down the financing arm. I'm not going to count that as value. Then you don't want other income in EBITDA. You want other income below EBITDA. And I'm just going through this very quickly because we talked about this before, right? So one example of looking at whether to count line items or not is, what are you going to get? We'll talk about this in M&A when you're buying a business. What are you going to get? What you're not going to get? What are you going to get should be up in your EBITDA because you're going to value the business off of that. That's one perspective. The other perspective is comps and valuation, right? So when looking at the car company and when looking at comps now, forget M&A, looking at comps. If one car company has the financing arm and income from the financing arm and your company doesn't, do you include it? Let's say you're doing comps of 8 different companies. Some companies have the financing arm, some companies don't. In order to put them all on an equal scale, I would exclude the financing arms because some companies don't. So that every company is on the same page. That's the thing about the comps. Some of this is subjective, and you'll never know. Some groups might say, no, let's include the financing arms because they're different. Some people will say, no, to be completely equal, let's exclude the financing arms. If not, everybody has it, so everybody's on kind of an apples-to-apples basis. This is an opinion. This is subjective. I'm just giving you things to think about and how to think about comps. So this is a good example of that. Pre-opening expenses. 2 questions. Number 1, is it non-recurring? And let's say this company, their plan is to open up 10 stores a year. So they will have this expense ongoing. But Erdal makes a good point. What if it stops? What if next year they say, you know what, our plan was too aggressive. We're going to stop that. This could be non-recurring. Even if it's in their plan today, will it be in their plan tomorrow? They can easily pull that out. So for that reason, I might consider this as extraordinary non-recurring. Maybe not. The other thing to think about is everyone else doing it, right? Does Walmart have pre-opening expenses? And they didn't. Does Target have pre-opening expenses? I don't know. I don't remember. If not everybody has it, then I would say be safe to pull it out because you want to compare apples to apples. I just want to know, I want my EBITDA to show the revenue they're making from selling products and from membership fees and the costs for that. The pre-opening expenses might skew our results. You kind of get what I'm saying? So I want to pull this out for that reason. And I also want to pull this out so I can show you what happens when you pull an expense out. Because you pull an expense out from above the line to under the line, tax deductions got to go with it. You're not getting tax deductions anymore. And a lot of analysts overlook that. Okay? So, recap. I want this revenue laid out. Merchandise costs will be our cost of goods sold. SG&A will be our OPEX. I'm going to pull out pre-opening expenses. Okay? Then we have interest expense. Let's start to lay this out because we have some other issues that are going to come through here. Okay? So, for revenue 97062, let's just lay that out. For 2012, revenue broke it up into two pieces, 97062. I broke it up into two pieces because Walmart broke it. We broke it up into two pieces. And 2075. And total revenue is the sum of the two. Okay. What I want to do, let me just open this up real quick. I want to, if you guys know how to group and ungroup, you can open this with the plus. I'm going to close this one. I thought I had a grouping where, I guess it didn't group, where I could still see 2011. Where's 2011? Here it is. I want to do 2012. Might as well do 2011 as well, so we can show the year-over-year growth. These quarters, we're going to open up. We're going to do the quarters later. So 2011 was 87048. And 1867, okay? And we're going to do the total revenue. And I'm going to do the year-over-year growth. I'm just going to do total year-over-year growth. This year divided by last year minus 1. That's going to help us with our projections. 11% growth, not too bad.
Page 7.
Oh, 87048. You mean the cursor was covering it? Yeah. Let me zoom in a little bit so you can see better. Okay. And then we're going to lay out our cost of goods sold. Okay. You okay? Back up. Okay. Cost of goods sold. We got 86823, 77739. 86823, 777, what did I say, 29? 77739. Okay, and I want to calculate these metrics for our later projections. COGS as a percentage of revenue. Okay, you should know this. I'm going to go a little fast, but I'll pause so you can catch up. And then we can calculate gross profit. Revenue minus COGS. You should know to put together an income statement. And the gross profit margin is gross profit divided by revenue, total revenue, all in the totals, okay? And I'm going to scroll up and I'm going to pause and you just let me know where you want to catch up here. Okay, so just to make things more efficient, I had jumped ahead and just hard-coded in the SG&A and then calculated down to EBITDA. So SG&A was 9518, 8691, calculated percentage of revenue, and then EBITDA was just gross profit minus that OPEX, and I calculated the margin. Okay, next we got depreciation. What happened? Where's depreciation? What do you guys think? We'll check the cash flow statement, but why?
Because it's embedded.
It's probably embedded, right? Everyone has depreciation. Well, you could. Some people maybe not if they don't have any equipment, but that's quite unusual. So the point is either why is depreciation not listed on the income statement? Either they don't have it. So let's see if they have it. If they do have it, bless you, if they do have it, they're going to expense it. They're going to get the tax deduction. So if they have it and they didn't show it here, it's probably buried in one of the operating expenses. So the question is, if that's the case, which operating expense do we pull it out of? So first, let's make sure they have depreciation. So we'll just do a quick word search. There's depreciation, so they have it. Okay. So what I first want to do is I want to list what the depreciation numbers are. And here's 908, 855. So first, let's list out the depreciations, 908, 855. So there's the depreciation expense. So I'm going to go back here and I'm going to list out 2012, 908, 2011, 855, okay? I'm going to calculate depreciation as a percentage of revenue because for comps, I don't do a whole big depreciation table. I just do a quick percentage of revenue. That's what we often do. You could take comps as far as you want, depreciation, amortization. But the question is, we found this depreciation expense from the cash flow statement and added it. You can't just add expenses to an income statement because all of a sudden the cash flow, the net income is not going to match to what they have, right? So we have to assume that that was buried somewhere. We got to pull it out of one of these operating expenses. It was buried in either cost of goods sold or OPEX, or SG&A. The question is where. So what you have to do is you have to continue the word search on depreciation, try to see if they talk about it, try to read between the lines to guesstimate where it is, and sometimes it's not completely clear. And instead of kind of searching through that with you, I had done the search, and in the book there's a couple notes. One is they spoke about in the SG&A section, selling general administrative expenses also include utilities, bank charges, rent, all building and equipment depreciation. So they talk about. So if I had done the word search, I would find this note within SG&A. They talk about all depreciation is included in the SG&A expense. I'm going to pull it out of SG&A. Okay, you might have to do a little bit of research for that. If you were wrong and put it into cost of goods sold, it's not going to. It's as long as it's coming out of EBITDA. That's what we care about. It's not going to change things all that much. So what I want to do is I want to take that SG&A and just adjust out the depreciation that we identified. So right in this H19, I'm going to do equal to that 8691 that we identified, right? Minus, and I'm just going to kind of click down to 855, right? I'm going to reduce that by the 855. So we just lowered, so we basically pulled the expense out of SG&A. See what I did there? Any questions on that? I could have just hard-coded in 8691 minus 890, whatever. I could have done that too. But and then also 2012, where this 9518, so equals 9518 minus, and just click the 908 down here. So now instead of just adding a new expense, we basically pulled the expense out of SG&A and moved it down. Right? We did this with Walmart in the beginning. Just practicing that further. Any questions? So then we have EBIT. EBITDA minus D&A. And we have the margin, which is EBIT divided by revenue. Okay. Okay. Okay, next up we got, we're up to other income. Now, if you notice a couple things, first of all, going back to the statements here, we just skipped over the pre-opening expenses. So we got to deal with that. We just said, you know what, we don't want to include it above the line, so we just jumped over it. We have to put it down below to make sure that we're tying to the final net income. Other income, we have interest expense. So let's lay out interest expense, minus 116 and minus 995. Now, this gets back to, for some reason, they start to change the logic, where an expense was a positive number. Now all of a sudden here, they made expense a negative number. I don't know why companies decide to do that all of a sudden. So I prefer to keep every expense as a positive number, and then if there happens to be an income coming in, make that a negative number. I think switching the logic is very confusing. Although here, at least they indicated that they changed the logic. We're putting expense in parentheses, but I don't get why. So even though this is negative 116, I'm going to show it as positive 116. Okay, so positive 116. So I'm going to jump down. This is other income section we're talking about. I'm just going to jump down to interest expense, 116. Positive 116. Okay. And then sorry, I went backwards. It's positive 95. And then 116 2011. Okay. I hope I did that right all the way through. 8691. We're okay. We'll know when we match at the bottom. Okay? So we're getting interest expense in there. You guys okay with that? Yes. And then interest income. Now, here they have lumped interest income with other income. We can't put this all as interest income. And you might see sometimes companies do that. They lump interest expense, interest income, and other income all into one section. For us, we want EBIT before interest. We need to separate interest from other income. We need to always separate that. We want interest movements in its own section. They seem to blend that together. So we have to dig that up. So I'm going to do a quick word search on interest income and other and see if they give a little bit more detail. Often they'll have a table breaking this out. So I'm going to do a word search on interest income. Keep going. Here it is. They broke it out. Here's interest income and other. Okay? And what this is comprised of is just straight up interest income. This is the interest income that we use in our interest section. And these line items are other income line items. Okay? That we've decided to put outside of EBITDA because they're not core to operating. What are these items, first of all? Equity from affiliates and other. What is that? You guys know what equity from affiliates and other are?
That's the non-controlling.
Exactly. What about them? More specific. You're exactly right.
If you have some shareholder,
Yep.
you have to give them the money.
Other side of the fence. That's non-controlling interests. This is if you have a non-controlling interest investment in somebody else. If this company has a non-controlling interest investment in another entity, if they own a little piece of something else, that entity gives them a dividend. It's income for them. It's other income. And they have to record that as income. It's the equity in the net income, in the earnings of other invested affiliates. They have to record that. So it's every day. They get it all the time. They have that investment permanently. But for our perspective, it's really not operating. So we have it in another income. We didn't pull it out as extraordinary, but the other income section is outside of EBITDA. It's below EBITDA. Got it? And then they have this foreign currency transaction gains losses. This is, again, maybe they have investments in other entities. They have a lot of dealings with other entities. They roll up the income statements from other entities, and there's some currency adjustments there. Okay? So we're going to list these two line items in the other income section, but the interest income is in our interest section. So interest income, I'm going to put that in parentheses because it's income now. So I'm going to have negative 49 and negative 41. So where's my other interest income? So negative 49, negative 49, negative 41. Okay, and I'll sum that up. Why not? This is our net interest expense. Okay, it should be positive because it's an expense like any other expense. I added the two together. expense plus the, less the income. Okay? So then I had already done this, I had created an other income section outside of EBIT, outside meaning below. And I listed these two line items. These are income flows, so I'm going to put them in parentheses. Make sure I was consistent in doing that here, yeah? I'm going to have, what was the first one here? Did I list it as the equity and earnings of unconsolidated affiliates? I put on top for some reason. I guess it just went down, up. Minus 14 and minus 10. Okay. And then underneath, the foreign currency transaction gains, losses. Minus 40, minus 9. Again, they had changed the logic. They listed income as a positive. I want on the income statement income as a negative. And I'm going to add the two. This is the total income received. Okay? This should tie up to be this match.
It should be okay if we do the reverse. X minus and minus.
Well, then your math has to change at the bottom.
I see.
Yeah, it's fine.
Yeah.
However, there's two ways. As long as the math is right, you could do it however you want. Yeah. Some people say, well, I want to match it the way they did it. That's fine. Then you wouldn't add, you'd subtract. Okay? $60, and this was 103. I just want to make sure these numbers match. This was 103 before, and there's 103. Okay, the total number up above in the income statement here was 60 and 103. I'm going to go back to the regular income statement. I can't tell if it was down or up. Okay, you're right. Yep, it's up. The total was 103 and 60. So I just wanted to make sure that this, when I broke it out, just double checking that the totals still match. And they do. So in other words, 103 is, here are the three income statement items that I had broken out. 54 and 49 is 103. So just doing a sanity check. Okay. Now, I can get my earnings before tax, which is going to be the EBIT minus other income minus net interest expense. 2429. Okay. And I can calculate the margin on that. Okay. Now, it's good to kind of check and make sure these numbers match, but this is not going to match what the annual report has because we did not include this pre-opening expense, so we can't tie these numbers yet. The whole point is that our numbers exclude that pre-opening expense, right? So I think we're at a good breaking point. Let's continue. We're all the way down to earnings before tax, and we have taxes to deal with. Now, this is tricky. What a lot of people would typically do is look at the tax expense and just drop it in. So 2012, 1767. But that's not correct because we pulled an expense out. So they're not going to get all those deductions. So if we're in a situation where they did not have those pre-opening expenses, which is what we want to simulate, there's going to be tax deductions that go with that. So the way we think about it is, let's look at the implied percentage that they paid. What percentage did they pay? How do we figure out how much they paid?
Tax they paid.
Yeah. Yeah.
Over the revenue or
EBIT. We'll back calculate into the implied tax rate, and then we'll calculate new taxes, built based off of our adjusted EBIT. That's the way we do it. So, in other words, for 2012, I'm going to go in and do, what are the taxes? 1,000 divided by 2,767. Okay? So I'm going to go in and I'm going to go in the tax rate is what I'm going to hard code. The effective tax rate is 1,000 divided by 2,767. So they paid about 36%. And in the year before, it's 841 divided by 2383. 841 divided by 2383. 35%. You see what I did? That's the implied rate. And I'm going to use that rate to calculate back into the taxes. Taxes are going to be different. They have more income now, less expenses. They're going to have more taxes. So if I multiply it back out, let's see, in 2012, for example, instead of just paying 1,000 in taxes, they actually had 1,013.4, assuming they got a little bit more profit. Right? We want net income to be cleaned of not only the expenses, but the taxes that go with it. That is a tricky process. How do you think?
I know, it's like the numbers.
Okay. I just want to make sure you know the concept.
Remember about EBT, not EBIT.
EBT. Did I say EBIT? Did we say EBIT? EBT. It's the bottom line. Yeah. Yeah, EBT, the bottom number. I'm sorry. And then we can pull what our net income is. Okay. 1790.6. Make sure you guys are getting that. Okay, so next we're getting into net income including non-controlling interests. Okay, that's what we have. Our number is going to be a little bit different because we have an expense pulled out. Here's net income attributable to non-controlling interests. So we're going to drop this in. Now, here, you want to double check the logic, right? The parentheses is reducing from 1767 to 1709. So I'm going to list this as a positive number. I'm going to keep the same logic throughout, okay? So I'm going to have 2012, 58, and then 80. You got 58, and then 80. Okay? And you see here I have a metric, that non-controlling interest as a percentage of net income, so that I can use that to project in the future. So I'm going to just take a look at what percentage of net income have they been paying. 5% seems pretty standard. I think with Walmart it was 4. I'll drop down to 3. Okay? And if I go back here, I want to see, are there any other line items? We basically included everything. They don't have anything else. So this is our bottom net income. This is our 1571 minus 80. This is our adjusted net income. Okay? Everybody having that? Questions on that? Now, I always strongly recommend to have two net. This is all we really need. This is what we're going to use for our comps. It's the adjusted net income. But I always recommend to list underneath the non-occurring events that we pulled out, and then underneath that have a net income that matches what they have on their statements. It's always important to have a net income that matches to prove to yourself that we were able to include everything. So I maybe told you the scenario that happens a lot where you get an income statement and your associates look at that and he goes, oh, pull this out, pull this out, pull this out. And then you have your net income adjusted. That's great. And then you send it in a pitch book to a managing director and he tries to do some spot checking and he sees that your net income doesn't match the annual report and he thinks everything's wrong. So in order to avoid that problem, I always recommend have two net incomes, lay it out clearly. Believe it or not, I don't see that in a lot of templates. Have the adjusted net income, then underneath show the adjustments that were made. In other words, show the non-occurring events and make sure that your adjusted net income plus non-occurring events should match to the net income at the bottom of the statement. Very simple. Okay, so let's do that. So underneath here we have non-occurring events, the pre-opening expenses that we've pulled out. But because we pulled them from above the line to underneath the line, it won't match. Why won't it match?
Oh, with taxes.
Taxes. We have to, when we pull it underneath, we have to pull it underneath times 1 minus the tax rate. Then it will match. So in other words, pre-opening expenses. What number did we pull out for 2011? We pulled out 46 for 2011. Yeah, that's just the column. I'm going to do equals 46. Did I say 46? 46 times, open parentheses, 1 minus tax rate. I took the pre-opening expenses times 1 minus tax rate.
What is pre-opening?
That's the expense up here that we eliminated. We excluded. And I'm going to do the same here. 37 times 1 minus tax rate. Okay. And then there's this line other items, which doesn't exist. I guess that was just left over from the prior template. I'm going to add these two, and I just want to do a quick subtraction. So the 1491.8 minus those pre-opening expenses should match what they have, 1709 and 1462. Did I do it right? 1709 and 1462. So it ties. That's a sanity check. We're not going to use that number, though, for our projections. For our projections, we want adjusted for our comps. We want adjusted for our comps. Okay, I did that really quickly because I was eager to make sure it matches in case I made a typo or something. Looks like it's okay. All right. Now, there's 2 earnings per shares I list, and this is kind of personal preference. I recommend it, but I don't see a lot of templates with this. There's earnings per share as reported, based on the as reported net income, and earnings per share adjusted, based on the adjusted net income. Obviously, the adjusted earnings per share is the one we're going to use for our comps. The reason why I list earnings per share as reported is so I know how they calculated EPS. Because as you know, there's several ways to calculate EPS. It's always net income divided by shares, but it's what net income? Is it net income before non-controlling interest? Is it net income after non-controlling interest? Is it net income before non-recurring events, after non-recurring events? I want to know how they do it so that I can make sure that I'm matching into their EPS. It gives me confidence that I'm doing EPS the way they're thinking about it. And then I'm going to apply that method to our adjusted net income. You don't have to show them both, but I'm going to. And in the future, for future projections, it's not going to matter. Future projections, it's all going to be as adjusted. So I just want to make sure that we're tying into net income the way they are. Yes, Berto.
I mean, earnings per share adjusted, it shouldn't be the same way what we did for Walmart.
It's the same way what we did for Walmart, yeah.
No, as you say, it might be different for each one.
Oh, you mean the, yeah, well.
If it is different for this one, the adjusted should be kind of adjusted the way the Walmart it is.
Adjusted is always going to be the same. Adjusted, we will always pull this net income, always, always, always for Walmart, for everyone, no matter what. I just want to make sure, because you never know what, some companies make strange adjustments to EPS. For me, it's a sanity check to make sure that that just because as net income matches what they're doing, it's a sanity check for me to make sure that the EPS matches what they're doing. We're using the same base share numbers. You know what I'm saying? I just want to make sure that the EPS matches what they have. But we're not going to use that. This adjusted earnings per share is going to be based on this adjusted net income, same for every company. Let's go through the process. I'm not sure if I answered your question. I'm not sure if I understood your question. Let's go through it and we can ask it again. So first of all, we need the number of shares. Okay? We're going to use theirs, obviously. They have it listed as basic 433620. Sorry, 2011. 436119. And diluted 443094. Okay. Now, I need to make a units adjustment. Okay. If you notice, some income statements, I don't think Walmart didn't have this issue, but some income statements changed the way they report the number of shares. I don't know why. Maybe they feel like shareholders want a little bit more detail. If you look at the top here, everything is in millions. But you might see this a lot, dollars and millions, except some share and per share data. Here it says per share data, but they mean share and per share data, meaning things dealing with shares, they have in different units. A little funny, but I think it's just because they want to report a little bit more, in other words, if you go down to shares, it says shares are reported in thousands, not millions. That's going to mess up our calculations. I like to keep everything in one unit. If the dollars are in millions, I'm going to put the shares back in millions. So it's not going to be 433,620, it's going to be 433.620. My guess is the reason why they did that is they didn't want to round so much for a share count. I don't know. So remember, in order for everything to be kind of apples to apples in terms of units, I'm going to convert this to the same units that the dollars are in, 433.620, okay? So I did 433.119. I'm going to do 436.119 and 433.094. Okay, everything in millions. And for 2012, 433.620 and 439.373. 373. Okay. Here, you can I'll just pull it here so you can see them. Yep. But I would just use the decimals. Okay, let's divide. I want to make sure that I'm getting the same EPS that they're getting, so I'm just going to take, I'm just going to take the net income as reported, divide by basic number of shares for basic EPS, and I'm going to take the net income as reported, divide by diluted. Let's see if that matches, okay? 335 and 330. 335, 330. All good. That's all I want to know. Okay, so we're on the right track. Just a second. Erdal, there's really it's not going to be used for anywhere. It just gives me, that's why I mentioned before, not everyone sees it. It just gives me comfort that we're matching. Who knows? Maybe I'm typing the share count wrong. It's just another data point. What we are going to use, though, is our adjusted net income. That's what we did for Walmart. That's what we're going to do for everyone. That's going to be the same. So what we're going to use, what we're going to pull into our comps is net income adjusted, which is which one? The 14918 divided by 436, and the 14918 divided by 443. Okay. Does everybody have this? Everybody okay with this? Now, this will give us metrics that we will use for 2012 historical comps. Sort of. Okay, so what do I mean by sort of? Okay, so I want to introduce the concept, and I'm going to try this on OneNote. I usually do it on the board. Let's see if this is more effective so I can continue to record this. I want to introduce the concept of making time adjustments because when well, let me start before getting to that level of complexity. I think I'm jumping ahead. First of all, when you look at Walmart, okay, this isn't necessarily the case for Costco, and I'll show you why in a second. When we look at Walmart, their annual report, okay, was of January 31st, 2012. Costco's annual report was 9 months later, October. Okay? When making comps, every company that you're copying against should be in the same time period to avoid the possibility of numbers being impacted by external market environment factors. October could have been a very different market environment than January. So if we have year-end comparable metrics, Walmart's 2012 year-end is January. Costco's 2012 year-end is October. Two different parts of the year, beginning, So what we want to do is we want to adjust Costco's data to have a year-end, the same time period of the company that we're copying against. If Walmart's year-end is January, we want Costco's year-end to be as of January. Otherwise, Costco's numbers could have been swayed or could have been adjusted by external factors. October just been a better environment than January 2012. Who knows? It's the right way to do comps. We have to make timing adjustments. We have to find out what Walmart's true timeline is in all three categories, LTM, 1 year forward, 1 year back, and adjust every single company that we're copying against to be exactly on that same timeline. So knowing already that Walmart's year-end is in January 31st of 2012, Costco is October 2012, we have to show a full year of Costco ending January 2012 to be completely in line with Walmart. We have to make those adjustments. We do that through a combination of LTM and calendarization adjustments. We want to talk about what those adjustments are. And then tomorrow morning I'll talk about how to make those adjustments for Walmart. It's going to be tricky. We're going to have to pull up the quarterly information and utilize the quarterly information. Okay? Now, a simpler step towards that is first we know that Walmart's year-end is January 31st, 2012. But we're in October, November of 2012, right? So clearly, if we want LTM data for Walmart, we have to utilize quarterly data for Walmart, correct? So when I mentioned comps in the beginning, I said there's three, in terms of timing, there's three areas of comps. You want to do historical metrics, you want to do forward metrics, and you want to do LTM metrics, which is ideally more current information. So knowing that Walmart's annual report was released 9 months ago, they must have more current data. And when you go to SEC.gov, sure enough you see they have produced a couple quarterlies. They've actually produced 3. So we can produce more current data by pulling last 12 months information. Last 12 months is using quarterly data in tandem with annual data to get at more current information based on those quarterly reports. So, for example, let's say, I'll put one note, with Walmart specifically, actually they only had 2 quarters out. I'm looking at my notes. Walmart specifically, okay, LTM. Walmart specifically has an annual report, okay, and let me see if I can make this a table, okay, that was from February 1st, 2011 all the way through January 31st, 2012. Okay, I'm going to make the font bigger so everyone can see. This was their annual report. This is what we were building our 2012 on. Okay. When we looked at SEC, we had realized they had released two other quarterly reports. They released a Q1 and a Q2. Let's see. Q1 2012, Q2 2012. Okay. The Q1 2012 was specifically from February 1st, the day after, 2012, 3 months out, to April 30th, 2012. Okay? And the Q2 was from May 1st, the day after, right, 2012, all the way out to July 31st, 2012. They didn't release anything else beyond that. I guess July, August, September, October, they just didn't release that one yet. So here I'm saying, okay, if I want LTM data, if I want as current as I can get with the information given, I can technically get annualized data as of July 31st, 2012. A lot more current than January. Here we are in October. It's not super current, it's as current as you can get though. So what I would do is, I'd pull up the annual report, say for revenue. I'd take the revenue, I'd pull up the quarterly reports, I'd add the Q1 revenue, I'd add the Q2 revenue. Give me a total revenue from annual 2012, Q1 revenue, Q2 revenue. That's what I would do, I would add. Problem with that is, that's giving me 18 months of data. I only want 12, I want annualized data. So if I'm going to add Q1 2012 data and Q2 2012 data, in order to keep this on a 12-month basis, I need to subtract out last year's Q1 and Q2 data. So if I take annual 2012 and I add Q1 and I add Q2, in order to further this, can I add another row?
Q1 2012 it shouldn't start with the 1-1.
What do you mean the 1-1?
You said Q1 2012 Q1.
2012 Q1, yeah?
Yes, you said.
This is the day after January 31st, it's February 1st? Yeah, good. But I need to subtract now Q1 2011 from the prior years. Okay? Let me pull this out. Why is this not pulling out here? Okay, here we go. Which is specifically February 1st, 2011 minus April 30th, 2011, okay, and May 1st, 2011 minus July 31st, 2011, okay? You got to think about that. It gets a little tricky. If I take this data, okay, and I add 6 months to that end, you give me 18 months of information. I need to subtract out 6 months from the back end. The same 6 months. Which will leave me with information from August 1st, 2011, all the way through July 31st, 2012. I now have 12 months of data up to July 31st, 2012. This is LTM, adding and subtracting quarters. Easiest rule of thumb is, whatever quarters you add, just add the same quarters from the year before. Just subtract the same quarters from the year before. Drew.
LTM is, again, the latest quarter that they have reported, right?
Mm-hmm.
The company that we found, and not the current month. So you could use, I guess, expectations and or...
You wouldn't project. No, you wouldn't make projections. You don't make projections with LTM. LTM is based on last reported data. Yeah, good point. Not to say that there are some analyses where you'd have to do that, very rare though, but that's not, LTM is usually just last reported 12 months. If you read that in equity research reports, it's usually the last 12 months.
So let me shoot Q2 to something like that. That's one.
Yeah, it's Q2.
Yeah. Or no?
It's kind of when you add the 2Q and then subtract the year before 2Q, it's kind of you justify the any kind of mistake.
What do you mean, adjust for a mistake?
And just if there is some anomaly in these terms, we kind of eliminate them.
You're smoothing out, you're making adjustments for different time periods, but what types of mistakes though?
Not mistake, maybe it's some anomaly for the company, something happened unusual for that company. When you subtract.
Yeah, it'll smooth that out.
Yes, that's the.
Yeah. Okay, that's LTM. There's another concept called calendarization. I don't think there's a right spelling for this.
Yeah.
D-A-R? Calendar. Oh, it's still going to come up as.
It's supposed to be S, maybe?
No, I think even. Yeah, I don't think. I don't think it's. When I was writing the book, it even came out like that. It was never in the vocabulary. But the idea here is adjusting within quarters. So for example, let's say that I have an annual report of a company that I'm competing against. I'm going to give you a completely, just blind example, not Costco, not Walmart. Let's say I have a company that has an annual report, 2011. I'm going to give you the year here. I'm going to give you 12/1/2010 all the way through 11/30/2011. So it doesn't quite get to December. Let me just make an adjustment here. Okay. So let's say we got a company we're competing against. We can say we're competing against Walmart, whatever. Okay. Let's say we're competing against Walmart. This is our company. It's a fictitious company. Costco isn't this. Costco is very complicated. I'm going to give you a simpler example, then we'll apply it to the more complicated one. We'll spend tomorrow on that. But let's say we have a company annual report, November 30th, 2011. All right. We want to be in line with Costco's January. Every company we comp against, when we do a year end, when we do LTM, it's got to be at the same time frame as the company that we're competing against. So if Walmart has a year end of January 31st, we want to get our company, we want to make an adjustment to get our company to that, to in line with that. So let's say, so what we do is, let's hope that the company has produced a Q1. And let's say they have. They actually produced 3 quarters, but we don't need 3 quarters. We just want 1 quarter. So their Q1, and I look up their Q1 is a time period of December 1st, 2011, all the way out to February 29th, 2012. Okay, so for us to have a year end as of February 29th, 2012, we have to add this Q1, and we have to subtract the prior Q1. Okay, we got to subtract the prior year's Q1, which is December 1st, 2010 to February 29th, 2011. Right, so we add that Q1. So now basically what we have is we have a whole, we've adjusted our company to be from March 1st all the way to February 29th, 2012. Okay? You're okay with me now? So we used LTM adjustments. We adjusted quarters. It's still not close enough though. We want a year end as of January 31st, not February. Their quarter went out an additional month. So we haircut the quarter. Okay, so we apply a metric, and in this case it's very simple. We'll just multiply this, Q1, by 2/3. We only want 2/3 of this information. We want to wipe out 1/3. We want to wipe out the last month, 1 out of 3 months. So if we take this information, this quarter, and multiply by 2/3, then we're effectively getting the first 2/3 of that quarter, February all the way to January 31st, 2012. And if we're multiplying 2/3 by this, we have to subtract 2/3 of this. That'll get us from February 1st to January 31st. That's the impact of calendarization. Yes, Drew?
Questions. If it's different days within the quarter, sometimes they start in the middle of a week or in the middle of do you do it as part of 90-day calendar or do you do it as effective 20 calendar?
You got to count the days. So we do that with Costco. We have to count the days. Count how many days are in the quarter, and then count how many days you don't want. That's the right way to do it.
Calendar days, right?
Calendar. Well, what do you mean calendar days?
Like it's not trading days. It's not some shorter. It's still going to be like
Calendar
31,
days.
30, 31, right?
Calendar days. Oh, calendar days. Walmart makes sales on Saturdays.
Yeah.
Yeah,
Let's
calendar
say
days.
if you do for the one kind of banking, regulation or whatever, and at that time you have to consider the just the business. That bank doesn't really
I don't know. I wouldn't say that. Like what kind of bank? Banks are open on weekends now. Saturdays. You count all the days. Yeah, you count all the days.
It's probably overcomplicated.
Yeah. I mean, I think this is all overcomplicating, but this is, I want to show you the procedure. So, when we look at Costco, we have to use these analyses, and this is all in the book. I would read it in the book because it's really complicated. I mean, at least the intro. Costco, at this time, by October, had 3 annual reports, 3 quarterly reports. Okay, their year end was October. They had 3 interim quarterly reports. Tomorrow, I want to lay out the dates of those reports. I want to lay out the annual reports, and we have to think about how to adjust Costco to be on the same timeline as Walmart. When I say same timeline, Walmart's year end is January 31st. So we need our Costco year end to be as of January 31st. So you see we have our year end here, but to the right, you can't, it says year end adjusted. This is what we use for our 2012. It's 2012 adjusted to match Walmart's year end. That's what we use for our comps. And then we need LTM. The LTM is not just taking Costco and then adding quarters and subtracting quarters to get to Costco's LTM. We need to get to a timeline that matches Walmart's LTM, which we now know is July 31st, 2012. So how do we lay out the combination of Qs and historicals to get to the year-end adjusted and LTM year-end? So we're going to do that tomorrow. Probably take the whole class. Now, I don't want to, since that's an interesting discussion, I don't want to spend the day hard-coding in all the quarterlies. So I'll send you the model with the quarterlies in there. It's the same process. If you want more practice, I recommend you to read through the pages that step through how to lay out the quarterlies. There are some additional adjustments in there that we didn't do. Sometimes quarterly data is different. But I'm not going to go through it. If you want to go through it, it's in the book. I will email you the model. I'll post the model on the shared drive that's updated with quarterly data in there, and tomorrow we're going to use the quarterly data to make our year-end adjustments, LTM adjustments. If we have time, start making projections. And then Wednesday we'll finish the projections, and that's kind of where we're at. Okay? Okay. Alex, yes.
Can you go back to the Q1 and 2/3?
Q1 2/3.
But I didn't follow that, so if you could just spell that again. You're passing the annual cost curve.
Yep.
Then you're passing the Q1. What are you standardizing?
Say it again.
What date are you trying to standardize?
January 31st. So I'm taking this whole quarter, and I'm saying I just want 2/3 of that. I want the first 2 out of the 3 months. I want December and I want January. Right? And then I have to subtract the same thing. So last year's Q1, I want to wipe out 2/3 of that. I want to wipe out December and January. That's the thought process. Yeah. Make sense? Good. Okay. Tomorrow we'll further this.